What are you watching the most closely in the next few days and weeks?
So obviously, the first and foremost is that we get the banks. And the banks are going to give us insight into what's going on with consumers and businesses and how they are weathering the storm and how they're preparing for the storm. And so I think the banks surprised everyone the last couple of quarters as they started to provision. Obviously, their outlook on the economy, businesses, and consumers were very different, particularly from our colleagues who were trying to build bull cases. And so I think that that will give us the first insight. I am a little bit worried about the health of the consumer balance sheet. As we've noted before, not only did credit card openings every quarter set a record, but the savings rate dipped to 2.3%. And so I'm a little bit worried about the health of the consumer as we go through this, particularly as I think Fed action is going to be more aggressive than most people are anticipating. I see a terminal rate of probably 6%. You mentioned Neil Kashkari, who's been among the most dovish of the Fed presidents, and even he penciled in 5.4%, we saw in that note. So I think the market's probably ill-prepared for that. And I think that the earnings, as we know, have come down pretty dramatically, the estimates.
But, you just heard those stats, Greg, that consumer companies, airlines, cruise lines, all of them are up 20%. So clearly, at least in the first few days of the year, and I know it's a couple days, the market doesn't appear that worried about the consumer.
And there's reasons to not be worried. And obviously, consumer confidence has come off of a low, and we see those surveys. And the consumer's been spending. Consumer spending has not cratered as one might think in the midst of a recession. But at the end of the day, I think that we've been doing a lot of that on leverage, as I noted, the savings rate and the credit cards. And that runs out at some point, Brian, particularly if the Fed is trying to drive to 4.5% unemployment. I think we'll see all of that spending come under pressure. And so I think that the market's forecast where the consumer is going to be and how they'll continue to spend might be off a bit.
Yeah, and then we got the Fed speakers as well. Hopefully the Fed's going to be pretty much off the table. Maybe we get a slight rate hike at the February meeting, but that's probably going to be it. Once the Fed is finally out of the picture, which it will be, hopefully, Greg, sooner than later, by the way, what then? I mean, it's like we've been addicted to the Fed for so long. What then becomes the focus of the macro market longer term?
I think we get back to valuation. And I don't think that I think that the Fed will remain in the picture probably a little bit longer than you're intimating, Brian. I think that there's probably another 200 basis points to go. And, once we get past that headwind, once we get past that, trying to connive what the Fed's going to do and reading into every data point, trying to predict their actions, which I think we'll get past in the second quarter, then we can return to valuation, provided that the estimates are reasonable. I think that happens by the second quarter as well. And now we can start to tell if things are cheap or expensive. Just because something's been crushed doesn't mean it's actually cheap. But we have no reliable valuation metrics unless the estimates are reliable.
Okay, then, if you're right and we get another 2%, aka 200 basis points, by the way, I got to pay myself money. I said I wouldn't say basis point anymore. What does that mean for valuations? Because when rates go up, the whole market has to revalue, which it did. And that's what we saw mostly in 2022, bring those multiples and those estimates down. If we go up another 2%, are we fairly valued? I know you have to go stock by stock, but for the macro market.
So, these things are connected, right? If we go up another 2%, I think that has to be taken into account for those, third and fourth quarter estimates. And they need to come down. Right now, they're too high at high single digits. I think that that's rather unlikely. But once they do come down, now we can at least determine what a reliable multiple is. If we're using estimates that are 10 to 20% too high, it's really hard to rely on a multiple to say something is cheap. So I think once we rebase in terms of where the estimates are, once the Fed is out of the way, at least we can reliably perform the exercise of valuation.
Yeah, and if we got all these bank earnings out, let's say the banks come in great. Okay, I want to be optimistic. It's Friday. The banks come in great. The numbers are good. The guidance is better. Does the market take off, or do you think this 5- and 6-day run we've had for the S&P and the NASDAQ, that's the expectation of decent numbers from the banks? Because the banks do have the power to move the market, Greg.
And so there'll be two things we need to look at for the banks. As everyone has noted, the net interest margin environment has become much more positive for the banks, and that's where they make the lion's share of their profit. And so that can remain intact, and that can remain something that's progressing. But at the same time, we're going to have to look at that provisioning, because the loan book and how it seasons and the losses that they're preparing for will give us a good view into what and how the consumer and the businesses will be affected. So the banks can actually do well, but we have to take a look at those provisioning numbers, because that's going to tell us what's going to happen, mid to end year.
Well, okay, we meet up this time on December 31st or whatever the last trading day is of the market. Where do we see the market, higher or lower from here?
I think higher. I think we're probably range bound for the first half. I think it'll be volatile. I think the estimates need to come down. I think we need to agree on what the Fed's going to do. Right now the Fed's telling us one thing, but Fed futures is indicating a terminal rate below 5%. And I think that the market will probably be surprised by the actions that they take, that they told us they're going to take. So I think we're range bound for the first couple quarters, but once those estimates come down, rally in the fourth quarter.